Hello, good morning, and welcome to all, and welcome to today's Daily Dose of Market Insights. Very good morning. I hope that you all have a good, restful National Day weekend. I'm Kelvin here. Very good morning to all. Welcome to a brand new week. Today will be Monday, the 12th of August, 2024. So, as usual, before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. As well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so as usual, let's have a quick recap what has taken shape on last Friday, and as well as in terms of key economic data events, its respective the respective price action of the key cross asset classes. And lastly, is there any I will share with you the longer term intermarket dynamics or fundamentals, and as well as any short term, as well as lastly the short term intraday technical outlook on the various cross asset classes. All right, so let's start with last Friday. So last Friday, in terms of the US stock market performance, so what you could see over here is that all four major stock US indices all ended in the green, except for the Russell 2000, which is down slightly negative 0.17%. So the SPX managed to gain 0.5%, the Nasdaq 100 gained 0.5%, and the Dow Jones 0.13%. So all this came within our expectation, where we do expect a bit of what I call at least a short-term mean reversion rebound after that 3 to 4 weeks of corrective decline, kickstarted by the Nasdaq 100. All right, so what we could see over here in the heat map of the S&P 500, this was last Friday performance on all the S&P 500 component stocks on last Friday, almost all of them in the green, led by the so-called mega cap technology stocks. All of them are also managed to actually close with positive gain on last Friday, with the acceptance of Nvidia that is down slightly by negative 0.21%. But across the board, we do see a slew of green. All right, so if we look at from the sector perspective, that means we break down according to the 11 sector performance on last Friday. So on last Friday, what we could see that the communication services sector was the leading one, 0.87, then thereafter followed by healthcare 0.65 and technology 0.62%. So if you put it up from a weekly perspective, so they actually ended the week. Okay, over here, we could see the week over here itself was not that rosy. So almost, I would say it's a mixed bag performance. Mixed bag performance. So what you could see over here is that this two tail end over here, technology recovered plus 0.8%, followed by the top performer was energy plus 1.1%. So these are the S&P 500 sectors. All right, so by looking at the sectors, we're able to get a bigger picture of the market breadth performance. So after last Monday dramatic sell-off on the global major stock indices, not even on the S&P 500, even towards the rest of the world as well, what we could see is that at the end of last Friday, it was like a mixed bag, rather neutral. So what we could see over here is that materials, utilities, consumer defensive underperformed last week on a weekly perspective. And if you look at from a 1 month rolling performance, it's still rather not that great. Why? Because the technology sector, which is the biggest market cap inside the S&P 500, is still down negative around 10% or so. All right, if you look at it from this perspective over here. So what we could see over here is that based on this heat map across the board, yes, we do see a mean reversion rebound that is in place. That came with our expectation. But is this mean reversion rebound totally, will it lead to a brand new medium-term uptrend in the US stock market, especially the Nasdaq 100, which is still below the 50-day and the 20-day moving average? The answer is no. Okay, we do not have a very clear cut, we call it levels that or in terms of market breadth performance that indicate that we are at the start of a new medium-term uptrend yet at this juncture. Not enough evidence, so we're taking things one step at a time. And in terms of the FX market performance, it's rather mixed as well. So you look at the 5-day rolling performance of the dollar against the other major currency as of 12th of August, all of them now trying to trade sideways. This is the 5-day rolling performance. If you look at the 1-month rolling performance over here, so what we could see over here is that the dollar previously was the weakest against the yen and the Swiss franc. All of them are trying to actually cover this huge gap over here. So this, like I say earlier, the 3 to 4 weeks of global risk-off scenario has a dramatic we call it climax made on Monday, and after that climax sell off on Monday, things try to get normalized. That means the one that is what you call it, put in a way that the K-shaped performance in the FX markets now try to actually revert back to the mean. That means K-shaped performance, as in the lower part of the K, that means the dollar was the weakest against the risk averse currency. That means currency that performed well during risk aversion, which is the Swiss franc and the dollar yen, now has trying to actually mean revert. That means the dollar weakness now trying to get lesser and lesser against the yen and against the Swiss franc is what I mean. And also at the top of the K shape where the dollar was strongest against the commodities related currency that actually took the most hit during this synchronized risk off scenario that was seen last 1 to 2 weeks ago, especially on last Monday where it hit a climatic peak. The dollar also tried to actually right now showing lesser strength against the commodity related currency, the Aussie, the CAD, and the Kiwi was being a correlated play with the Aussie dollar. That means, i.e., dollar strength starts to dissipate against the Aussie, the Kiwi, and against the CAD as try to mean revert. So very likely, this short-term performance, this 5-day rolling performance will be more likely in the sideways range until we come to a risk event that is taking shape this week, which is the release of the US CPI data out on Wednesday. Right, so this is the dollar performance so far. And also on Friday, we do have a release of a key China data, which is the China CPI data and the PPI data for the month of July. So now let's take a look at the situation over here in the Chinese economy. So what we could see over here at the top of my screen, what I plot over here is the China core consumer inflation, excluding fresh food and energy, or food and energy, pardon me, and the China headline consumer inflation, that's including the food and energy. Yes, we see the headline inflation number starts to actually improve, going above the zero number, inching higher at 0.5% year on year from 0.2%, 0.2% year on year in the month of July. Okay, pardon me, this should be July, not June. Okay, so what you could see over here is that yes, we do see a higher low that is being take up on the China inflation number, but this is more like being impacted by food or energy prices, right? So if you strip out the volatile item, food and energy prices, the core consumer inflation number continues to actually inch downwards. Okay, there's no signs of picking up yet, no higher low. In fact, they dropped lower. So on July, they dropped 0.4% year on year from 0.7% year on year in June. Okay, so on a we call it, if you strip up the volatile items, core inflation trend in China is still showing risk of a deflationary scenario, all right, at this juncture over here. So one thing positive over here is that the factory gate prices also try to stabilize at this juncture, all right. So it remains the same at negative 0.8% as compared to the previous month of June at negative 0.8%, but it didn't plunge lower. So that's something rather positive, because whatever happened in the PPI, this factory gate prices, it will have an influence into the end consumer goods prices. So as long as this PPI didn't continue to plunge downwards, there's still a chance, hoping that going forward, this core consumer inflation, at least they try to go sideways rather than plunging downwards. And most important over here is that how does the consumer confidence being impacted? That will be reflected in the retail sales figure. Okay, so retail sales figure was very lackluster in the last 3 months. You look at it, it's shaping lower high. The latest one was in June, a positive 2% year on year, but it continued to inch downwards. All right, from a since last year April. Okay, going to inch downwards. All right, so rather lackluster reading. So this Thursday we will release the latest July figure. All right, so market will be paying back close attention to this July figure for the retail sales number. So if retail sales number continue to show lackluster scenario, that means i.e. The China consumer confidence is still on the downside rather than the upside, which means that whatever we call it potential gain that we see so far in the China stock market, its proxy, which is the Hang Seng Index, is more related to a mean reversion rebound rather than the start of a clear medium-term to major uptrend. And also not say that China policymakers are still not in favor of any forceful physical stimulus because they are still preferring the piecemeal basis instead. Okay, so these are the key economic data that was released on last Friday. Only one of them that I found it is rather important in terms of how their impact in the global markets going forward. Okay, so with that, today there will be no key intermarket dynamics or fundamentals. Nothing new to share because it's very similar to what I shared on Thursday as well. So for today, I'll straight away jump straight to the I would say that the short-term intraday technical analysis on the various major cross asset classes, starting with the FX market first. All right, so 1 second, let me expand my screen. Okay, good. Okay, so let's start with the euro dollar. All right, so the euro dollar on last Friday or on Thursday, after hitting close to the 20-day MA, it just traded within this sideways range. All right, still can't break above the medium term, or I'll say that the major, let me put it with the daily chart, the major symmetrical triangle range resistance that is in place since the high of 18th of July 2023. Almost a year, it can't break above this. It's I would say that it's a year-long symmetrical triangle range resistance that is in progress. It can't actually stage a clear bullish breakout last week, only on a intraday break above it on Monday after that dramatic synchronized risk-off scenario that took place. But at the end of the US session, it actually closed below this symmetrical triangle range resistance. All right, so we still got to respect it. There's no clear bullish breakout of it yet. So given there's no clear bullish breakout of it, and since last Thursday and last Friday, it just tried to trip in a range. So going forward on the intraday basis, and also given that this coming week on Wednesday, there will be a key risk-off event, a key risk event, not risk-off event, pardon me, my apologies, but tongue twisting, key risk event that is taking shape in the market, which is the release of the US CPI data on this coming Wednesday. Market will be very likely trading, the major crosses will be likely trading in a very tight range, and also given that the euro dollar is the biggest weightage in the dollar index, so market may not be able to actually have a clear trend on the intraday basis before the release of this key US CPI data on Wednesday. Pardon me, on Wednesday. So with that, for today on the intraday basis, we're gonna take things one step at a time. So given that it start to actually trade in a range since in the last two sessions, we'll turn neutral first between 1.0950, which is also right now the upper limit of that major symmetrical triangle range resistance that I showed you earlier on the daily chart. Lower limit will be the swing low on last Thursday, last Thursday, acting as a support level at 1.0895. So neutral between these two levels, 1.0895 and 1.0950. Unless price action managed to actually stage a breakdown on the intraday basis at 1.0950, then we could validate a short-term intraday bearish bias to expose the next near-term support at 1.0870, 1.0840 next, which is so close to the 200-day moving average, acting as a resistance. I think as a support, pardon me, not as a resistance. Next will be the sterling dollar. So sterling dollar on last, we call it Thursday, before we go for a national break, we do have a very tight short-term pivotal resistance at around 1.2730 level. This level here, they're looking for a bearish push down. First step to retest the 200-day moving average. That a breakdown below it exposes 1.2620. So it came very close on Thursday. Over here we could see on Thursday, and again during the US session at 9 p.m. almost hit the 200-day moving average. Then thereafter on Thursday US session, after that it managed to actually stage a bounce and it cleared above the Titan key short-term pivotal resistance on Friday, and it also starts to shape a bullish breakout above this former minor descending channel that I drew from the high of 17th of July. So with this break of this former minor descending channel, what we could see right now, potentially it could be in the midst of a mean reversion rebound scenario to actually retrace this certain portion of the decline that was seen on 17th of July all the way out to 8th of August, means last Thursday US session low, which is very close to the 200-day moving average. That's our first support. So with that, I'll be using 1.2715 level, very close to last Friday minor swing low area. All right, very close to it at as my short-term pivotal support level for today. So 1.2715 short-term pivotal support level, flip to a short-term intraday bullish bias for this potential minor mean reversion rebound scenario to play out on the sterling dollar. First resistance level to watch on the intraday basis, 1.2780, which is close to the 50-day moving average. Above it exposes 1.2830, which confluence with the 20-day moving average as well, coming close to it, and as well as the congestion area of 30th of June and 2nd of July. Only an hourly close below 1.2715 short-term pivotal resistance, short-term pivotal support, not resistance, pardon me, I repeat, only a breakdown with an hourly close below 1.2715 short-term pivotal support for the sterling dollar will invalidate today's intraday bullish bias to re-expose the short-term bearish bias again, to expose the near-term support level at 12660, which is a 200-day moving average. Below it exposes 1.2620 next. All right, I repeat, the next support level to watch if there is a breakdown of 1.2715, which invalidate today's intraday mean reversion rebound scenario. 1.2660, which confluence with the 200-day moving average. Below it exposes 1.2620 next, which is the lower limit of this minor descending channel. Okay, so that's sum up for the European currency. So with that, let us move on to the Asia Pacific currency, the dollar major against the Asia Pacific currency, starting with the Aussie dollar. So the Aussie dollar continues to push up. This also come in line with the mean reversion rebound that is being seen in the major global stock indices, more or less normalizing the synchronized risk off scenario, kind of abated, all right, since last Tuesday. So with that, it almost hit the first resistance level at 6610. So far the RSI still maintains in a very positive bias, continue to shape a higher low right above the 50 level mark over here. Okay, so still indicating some form of bullish momentum, at least on the intraday basis. This is the hourly chart of the Aussie dollar. So with that, I will have a Titan key short-term pivotal support for today at 65.40. So as long as 65.40 is not taken out on the downside, still maintain that short-term intraday bullish bias on the Aussie dollar. Above 6610 exposes 6630, which is the 50-day moving average, acting as a resistance. Above 6630 may see further potential, we call it a test on the next intermediate resistance at 6685/67 figure level, which also correspond to the congestion area over here of 19th of July, and also the 76.4 Fibo retracement of that previous swift move down from 11th of July all the way down to the 5th of August climatic low. Right, only an hourly close below 64.40 will invalidate today's intraday bullish bias on the Aussie dollar to expose the next near-term support level at 64.70, followed by 64.35 on an intraday basis. All right, so if we do the Fibo retracement of this ongoing rebound from the low of Monday all the way up to last Friday high, the 64.35 also correspond very closely to the golden ratio of 61.8%. Okay, that's the Aussie dollar. Dollar yen next. So no change in the dollar yen on last Friday. It continues to trade sideways, holding above our first support level at 145.40. So we tightened slightly the short-term pivotal support for today, taking into account of last Wednesday minus swing low area at 144.05. So as long as 144.05 tighten short-term pivotal support holds, we will still maintain that short-term intraday bullish bias on the dollar yen for this mean reversion rebound scenario to continue to play out. 148.50 first near-term resistance. Above it exposes 151 figure slash 151.70, which correspond to the 200-day and the 20-day moving average, acting as a resistance, similar resistance level as well. Only an hourly close below 144.04. Pardon me. Only an hourly close below 144.05. Tighten short-term pivotal support level will invalidate today's bullish bias on the dollar yen to re-expose last Monday swing low area at 151.60 slash 151 to expose last Monday swing low area at 141.60 slash 141.40, and below it sees 140.25 next. All right, so that's for the dollar yen. So with that, that sum up the intraday technical outlook on the major dollar pair, and let us now shift our shift our focus to the major stock indices, starting with the Hong Kong 33 or the Hang Seng Index. So the Hang Seng Index on last Friday, we have a bullish bias over here for the first resistance level to hit at 17,185 level. So the price action hit, and right now it starts to actually shape that so-called bearish reaction of it, and also of the 200-day moving average. And if you would look at the current RSI over here, okay, taking into account of this low, okay, the current the RSI also broke below a parallel support level. Okay, previously was supported, now it break below the this parallel short-term key support level, and also has a bearish reaction right at the previous support, now turns into a pullback resistance. So indicating to us that the previous minor bullish momentum has more or less been evaporated, all right, at this juncture. So with that, I will flip to a short-term intraday bearish bias, all right, taking into account of last Friday's swing high as my short-term pivotal support level right now at 17,270. Okay, let me change this. Okay, let me copy over. Oops. Okay, 17,270. Okay, 270. So this will be our short-term pivotal resistance for today on the Hong Kong 33 or the Hang Seng Index. Okay, did it. Okay, so as long as this 17,270 short-term pivotal resistance is not surpassed to the upside, which correspond to the downward sloping 20-day moving average as well, whatever rebound that we see since last Monday on the Hong Kong 33, it doesn't have this upside momentum to support it at this juncture because of this bearish element that's being flashed out on the hourly RSI. So with that, there could be a risk of a intraday bearish bias that is unfolding right now on the Hong Kong 33. So using 17,270 short-term pivotal resistance, near-term support level to watch on a intraday basis for this potential bearish bias to play out on the Hong Kong 33 index will be at 16,890, followed by 16,720 next. A break below it, revisit last Monday's swing low area at 16,460 with the break, if the 16,720 level can't hold. So shifting to a intraday bearish bias on the Hong Kong 33. Unless the Hong Kong 33 managed to see a rebound, that means an hourly close above 17,270, then today's intraday bearish bias will be invalidated to see the continuation of this mean reversion rebound to expose the next near-term resistance zone at 17,410, 17,517. Above it sees 17,750, which also correspond to the downward sloping 50-day moving average. So that's for the Hong Kong 33. Onwards will be the Nikkei 225 or the Japan 225. So the Japan 225, like the dollar yen, continue to trade sideways. Last Friday, it almost retested the first resistance at 35,755 before shipping sideways again. So it seems to us that right now over here, it is in a sign of a minor bullish ascending triangle range configuration. Okay, that I depicted over here, all right, with the top of the limit of the range at the symmetrical, the ascending triangle range resistance will be at 35,755, but continue to trade a series of higher low, and that is also being depicted by the hourly RSI as well. Higher low going up above the 50 level mark, so still indicating some form of short-term upside momentum that is still, or bullish momentum that is still inherent in the Japan 225. So with that, we will have a tightened key short-term pivotal support level for today, which is the lowest point of this ongoing symmetrical triangle, the lowest point of this ongoing ascending, minor ascending triangle range configuration. So as long as 33,970 tightened short-term pivotal support level holds, we will still have maintained that short-term intraday bullish bias on the Japan 225, i.e. the Nikkei 225, above 35,755, exposes the next near-term resistance zone at 36,885 / 37,480, which confluence with the 200-day moving average and the 20-day moving average, acting as a similar resistance zone level as well. Only an hourly close below 33,970 will invalidate today's intraday bullish bias to see further potential weakness. That means, i.e., we could start to see the start of a renewed impulsive down move. In first step, to retest 32,710, followed by 31,400 next on the intraday basis. So that's for the Japan 225. Okay, moving on will be the one of the European major stock index will be the German 30 or German DAX. So the German DAX last Friday, it surpassed our short-term pivotal resistance level. Initially, we were looking for a pullback towards 17,250, which it didn't happen. So we got to respect the bullish price action, and also with that, we will flip to a intraday bullish bias on the German 30 or the German DAX for today, using last Friday pivotal resistance now turns into a pivotal support at 17,530 level. We also correspond with the 200-day moving average. All right, so what we could have is that we have the first support level at 17,650, right? But I don't want to pull it so tight. I use as my pivotal support for today, so I push it slightly lower because it's so confluence with the 200-day moving average. So as long as any potential dip or pullback didn't surpass below 17,530, we will flip to a short-term intraday bullish bias for today on the German 30, with the next resistance to watch out for will be at 17,960 and 18,140 in the midst of this ongoing mean reversion rebound scenario. So if you were to look at the ongoing minor so-called channel, okay, the top of this channel also correspond to 18,140, which is the 20, close to the 20-day moving average, and the 50-day moving average acting as a resistance level. Okay, very close to it. Only an hourly close below 17,530 will invalidate today's intraday bullish bias on the German 30 to reinsert the bearish pressure back again on the German 30 to expose the next near-term support level at 17,250, followed by 17,030 next. The major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 hit the almost hit the first resistance level at 39,840 level. So push up, then trade sideways. So with that, the first support level to watch, we could be using last Friday low. All right, last Friday's US session low will be which is at 39,230 level, but it's very tight. So I rather use the lower limit of this ongoing minor ascending channel, which is at 38,860 and 38,860. If you do the Fibo retracement of last Thursday's swift move up, all the way up to last Friday high is so close to the 76.4 Fibo retracement as well. So as long as any minor pullback didn't surpass below 38,860, we will still maintain that ongoing bullish bias on the US Wall Street 30. Next resistance level to watch 39,840, then thereafter followed by 40,110 on the intraday basis, which is correspond to the 20-day moving average acting as a resistance level as well. Only an hourly close below 38,860 will revisit Monday's low, which is at 38,375, which correspond to the 200-day moving average as well. Right, so that's for the US Wall Street 30. The Nasdaq 100 next. So the Nasdaq 100 continues as well to trade within this minor ascending channel, almost hit our first resistance level on last Friday at 18,680. So what we could do is that we could actually use last Friday low, swing low as my first support level, 18,310, close to it. But with that, this level is a bit tight, so I'll use slightly lower at this lower limit of this minor ascending channel, and also close to the 200-day moving average that managed to actually help on last Thursday before it shaped that swift rebound. So this is indeed a key pivotal support level based on the prior price action, the prior bullish price action. So in order for the bulls to maintain its ongoing bullish momentum, that means i.e. for us to maintain this intraday bullish bias that we will have, whatever potential pullback or dip in the price action of the Nasdaq 100 shouldn't surpass below 17,960. That's our tightened short-term pivotal support to maintain this ongoing bullish intraday bullish bias on the Nasdaq 100. Above 18,680 exposes the next near-term resistance zone of 19,100/19,230. We also cross confluence with this downward sloping 20-day moving average, acting as a similar resistance as well. Only an hourly close below 17,960 will invalidate today's intraday bullish bias to revisit last Monday's swing low area at 17,400/17,310. Okay, so that's for the Nasdaq 100, and also sum up our intraday technical outlook on the major stock indices. Now let us focus our attention now to the commodities market. So commodities market, starting with gold XAU/USD. For those who follow our daily dose on a daily basis, like I mentioned, gold on a very short term is now trading within a symmetrical range resistance level on an hourly basis since its all-time high of 17th of July, depicted by these two purple line here. Okay, it's trading within the range. So on that Monday, that sell-off, it managed to actually find support at the lower limit of the range and starts to trade higher and surpass above the 20-day moving average right now. So right now it's also enrolled towards the upper limit of this symmetrical triangle range resistance on a short-term basis, which is still being trapped within this symmetrical triangle range resistance. So no change. We'll still maintain that short-term intraday bullish bias with a tightened key short-term pivotal support level right now at close to last Friday low, and also the 20-day moving average that's acting as a support level right now. So as long as 2,415 is not surpassed to the downside, we still maintain that intraday bullish bias for it to continue to evolve towards the upper limit of this symmetrical triangle range resistance at 2,457, 2,470. All right. Only an hourly close below 2,415 will invalidate today's intraday bullish bias for it to float down towards the lower limit of the symmetrical triangle range configuration. Next intraday support level to watch 2,380. That was this minor swing low area since last Wednesday. That was tested on Thursday. A break below it re-exposes 2,370, which is the lower limit of this symmetrical triangle range resistance, as well as confluence with the dramatic last Monday minor swing low. Okay, so that's for gold XAU/USD. West Texas crude oil. So West Texas crude oil on middle part of last week, we flipped to a bullish bias. Why? Because the West Texas crude oil, that dramatic sell-off, managed to actually hit the support level, the symmetrical triangle range support level on Tuesday. All right, on Tuesday. All right, so this is the symmetrical triangle range support level that is in place since 20th of March 2023, a major one because this is derived from the daily time frame. All right, so currently the price action has really evolved. All right, it almost hit our first resistance level that we highlighted before we go for our national break at 78.46. And interestingly, the hourly RSI starts to shape a bearish divergence. So indicating to us that last Thursday push up towards on last Friday, the momentum is losing strength. With this momentum losing strength, and it's coming very close to the first resistance that we highlighted on Thursday, we saw confluence with two key technical elements, the 20-day moving average and the 200-day moving average, also acting as a similar resistance at 78.46. So using 78.46 as my short-term pivotal resistance, there could be a risk of a minor setback on the intraday basis. So with that, we will flip to a short-term intraday bearish bias on West Texas Oil. First support level towards 76.30, followed by 75 level on a intraday basis. Only an hourly close above 78.46, that means a breakout with an hourly close above 78.46, short-term pivotal resistance, will invalidate today's intraday bearish bias to see the continuation of the mean reversion rebound scenario to unfold, to test the next near-term resistance level at 79.65 slash 80.30, which confluence with the 50-day moving average acting as a resistance level as well. So with that, that sum up today's intraday technical outlook on the major cross asset classes. So before we go, let's take a look at the calendar. What are the key data to look out for today? So today calendar will be very quiet in the European session. So during the US session at 11 p.m. Singapore time, we do have the consumer inflation expectation for the July. So this is being compiled by the New York Fed. Okay, the New York Fed, every month they will compile this level. So let's look at the trend of this is compiled by the Federal Reserve Bank of New York. So this is actually a survey-based data looking 1 year ahead, where the poll is, they ask the respondent where what will be their inflation expectation 1 year ahead. So it has been slowly declining since April, all right, so inching towards that so-called 2% level mark that is being desired by the Fed. So the Fed actually has this inflation target of 2%. So if we continue to see the numbers inching downwards again today, because if we look at the calendar, okay, there's no consensus forecast at this moment in time. So if it continues to actually inch downwards below 3%, that means very likely it will still maintain that almost high odds of expectation that's being priced in for the first interest rate cut in US to come in the September FOMC meeting. Then other than that, the calendar will be very, very quiet. So what we have over here is that during the, okay, this one was more or less is to actually depict how the situation in China, money supply and as well as outstanding loan growth in China, which is very lackluster. So market is expecting a slight uptick to 8.8% year on year. It could be released by today, but no time is given. Okay, so it could be released during the evening session as well, once the Asia market session close. Then other than that, there will be no Federal Reserve official speaking today. And during Asia session tomorrow, before our daily dose at 8:30 a.m., we do have one consumer confidence data out from Australia. They call it the Westpac consumer confidence for the month of August. That's out at 8:30 a.m. Singapore time. So with that, that's pretty much sum up today's daily dose of market insights. So I'm Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.